So fixed income investments are a very important part of an investor's toolkit. And so we're going to get to sit down with Ramon as he and Raul speak about this asset class and how we are talking about positioning in this pandemic. You need to hear this if you want to accelerate your investing. Can we get some water on set?
We're here with Ramon Small-Ferguson, and he is the Vice President of Asset Management and Research at Barita Investments. Morning, Ramon.
Morning, Raul. How are you doing?
I'm all right, man. It's very good to see you this morning. So we can just jump straight into it. From an asset management perspective and a broader company perspective, how are you seeing the markets and fixed income in particular?
Well, I mean, obviously, every single section of the market has been impacted by the ongoing COVID-19 pandemic. I mean, this unprecedented situation has spared no asset class, spared no region. You know, this is one of the situations where, although diversification is important, the positive benefits of diversification are eroded because, you know, just everything, most things, tend to go in the same direction in a situation like this. So fixed income markets are no different. And what the COVID-19 pandemic has brought on is a significant decline in the prices of those securities. I mean, across the board. You know, when persons panic, they tend to sell risky assets and go into less risky assets. And we've seen that. So even the government of Jamaica bonds, for example, that trade internationally, were not spared. I mean, we saw a precipitous fall, a serious fall off in the prices across the global bond curve. However, that being said, you know, in any situation like this, there is a silver lining, and the silver lining is everything is certainly cheaper than it was before the crisis, right? So now it presents an opportunity, in my view, to look around and kind of seek out value, you know, what still remains fundamentally sound. So that's really our outlook, you know, looking for opportunities in the midst of all the confusion and uncertainty that's going on, especially in the fixed income space.
Okay, cool. So let's just pull back a little and just start with a little basics. Just explain what fixed income investing is.
Sure. So, I mean, at a very basic level, I suppose you can break fixed income investing into kind of two main categories, right? Or two main types of assets. So you have bonds, which are generally longer-term fixed income assets, and you have money market securities, which are shorter-term fixed income assets. So examples of money market securities might be a bank CD. That's a fixed income asset, believe it or not, where you place money with a bank for a shorter period and you get a fixed interest rate of return. You know, you could be talking about a repurchase agreement. So you go to your broker and you place your money on a repo, so to speak, and again, you get a fixed rate of return. Or you might buy, you know, a government of Jamaica treasury bill, which is a shorter term solution, a 3-month or a 6-month or a 9-month solution. And again, fixed rate of return. So that kind of is a set of examples of money market instruments. And then you have bonds, which are longer term. And generally, you know, they're usually over a year to be classified as a bond. And bonds are really at a very basic level a loan that an investor makes to a country or company. That's as basic as it can get. You know, so while for stocks, you are buying an ownership stake in a company, for a bond, you are basically acting as that company's creditor. You know, you're lending them money. And in exchange for you lending them money, they pay you a rate of return. I mean, that rate of return can be fixed or it can be variable. So, you know, a company might promise to pay you every 6 months the government of Jamaica treasury bill rate at the time plus 3%. So that's a variable rate bond. And a fixed rate bond might say, you know, I'll pay you 7% every 6 months until this bond matures or until it becomes time for the company or country to repay you. So that's basically, you know, broadly how I would describe what fixed income investments are.
Okay, and you say in light of the coronavirus pandemic, we saw the prices of those bonds move down.
Yes.
And therefore, the yield would have moved up, right?
Correct. So, I mean, that's an important point of note, Raul. So, you know, with a stock, you generally tend to focus on the price, right? And you also think about dividends when you're investing. For bonds, to your point, there are two main components in relation to bonds. You have the price, which is the price that the investor pays in cash. And you have the yield, which is the corresponding return that you get for that price. So to give you an example, if you're investing in a bond that pays, 8% every year upon $100, invested, then the yield or return that the investor will get is 8%. But should the investor decide to pay, instead of paying 100, they pay 105 for that bond, then that yield comes down a little. So that yield might now be 7% or 6.5%, depending on how long the bond lasts for. So price and yield have what is known as an inverse relationship. The more you pay, the less your yield is on the bond.
In light of the coronavirus pandemic and all the market reverberations that we saw there, what's your current outlook, and do you see any opportunities?
Well, I mean, but the outlook is still being formed. It's evolving every day. The fact is, as I would have said before, this is an unprecedented situation, right? So, we are living by the data. And we are not afraid to pivot and change course as may be required. But that being said, we do see a good bit of opportunities in the midst of this crisis in relation to fixed income investments, right? As I would have mentioned before, over the last 10 years or so post the last crisis, the fixed income market in general has done very well. And a couple of factors have contributed to that. We all know that post the 2008-2009 crisis, central banks around the world were kind of unified with certain type of measures, right, which have collectively been described as being expansionary. Right? So central banks have lowered interest rates. And remember before I told you about the relationship between price of these investments and the yield. So naturally with interest rates going lower, prices are moving up. They've also put a lot of money into the system. So central banks have been ensuring that there's a lot of liquidity around. They've been availing money to the banks and telling the banks go out and lend. And naturally, for those of us who know about demand and supply, if there is more demand and around about the same amount of, well, let me put it the other way. If there is more supply and around about the same amount of demand, then prices go up. So all of this money that's out there kind of chasing assets, giving loans, investing in securities, have also fueled the prices higher. Right?
So you had more money chasing the same amount of securities.
Of assets, exactly. So what this crisis has caused or forced is a significant pause or a breather in that uptrend, that general uptrend that has been happening. And prices, instead of going like this, have come back like this. Now, what that creates, Raul, is that because, as I mentioned before, because of this crisis, everything has come down. The good, the bad, and the ugly. Right? Some of these securities have certainly gotten to fair levels of pricing. Right? So before, they may have been overvalued, too pricey. Now they're at fair levels. Some of them have not come down enough. Some of them still, need to be adjusted. While others may have been sold off way too much. Right? They've just been sold off in the panic with everything else. And that's what we've really been looking for, those type of opportunities, good companies and countries that have been too severely priced down because of this crisis. So that's really where the opportunities are, looking for countries and companies that will likely be more resilient in the face of COVID-19, who have built up strong reserves, who have strong cash flows, who may have products that are still demanded even in this time from the company perspective and from the country perspective, who have good reserves. They were making hay when the sun was shining and they were putting away something for a rainy day and now rain is falling. Yes, so those more resilient ones, and two, you want to look for companies and countries that are poised to snap back very quickly. Once this crisis abates, we may not have an exact timing as to when things may go back to what we think is going to be more of a new normal. But you want companies and countries that have the ability to rebound very quickly. So again, we're looking for opportunities in that category.
Okay, so we keep looking and we're guided by the data.
That's correct. That's correct.
So do you have I guess like you said before, the outlook is continuing to be formed.
Yes.
So if we can come to Barita's main, and you can tell me if I'm wrong, but the main vehicle for client participation in the global bond markets.
Yes.
One of our premier vehicles, the FX Bond Fund, and Barita Unit Trust.
So I can talk about the numerous vehicles available, but just to go back to the outlook. So our outlook, to be clear, is that we will see a return of an upward movement in prices, right? We think it will be selective. So, we don't think there will be a rising tide lifting all boats effect. We think that some companies may not emerge from this crisis. It may be crippling for them, quite honestly. We think a few names that have been around for many years might disappear.
Oh, really? Like Lehman style?
Well, there are a few others. You see what's going on in the retail space. Companies that have been stalwarts in the retail industry. Because of the restrictions imposed by COVID-19 and just general market conditions have been forced to take a pause. Some persons have filed for Chapter 11 bankruptcy in the United States. So, we think some names may disappear, but we think that being said, some companies may emerge stronger and more resilient. So, that's really our outlook. But to talk about the vehicles that are available to our investor base at Barita, we afford our investors both direct and indirect participation in the global bond market. So bonds, unlike stocks, tend to trade in higher increments. So, unlike a stock, we're, talking about the global market now, you might be able to buy $1,000 of a stock fairly easily. You buy a few units, a few shares for $10 a share. Bonds tend to trade in higher quantums. So reasonably, bonds tend to trade in 50, 100, 200,000 quantums. So the type of investor who invests directly in bonds should have the capacity to appropriately diversify, and therefore it might mean that the minimum investment that you want to make if you're making a direct bond investment might end up being larger, right? But for those clients for which it is suited, we do provide direct access to the global bond market. Now, in terms of the broader cross-section of persons around, the broader cross-section of the investing public who might have a smaller portfolio, we do afford indirect access to the bond market, both locally and globally, via our unit trust products. So we have a couple of funds that are more focused on investing in money market securities, which I mentioned before, which is our income portfolio, which focuses on investing primarily in Jamaican dollar, corporate and government debt securities, which provide some stability and which allow investors to get a monthly distribution, a monthly income, right? And that's on the more conservative side for persons who don't want to risk, they put their principal at a lot of risk. We have that fund for them. We also have a money market fund, which again is fairly similarly positioned, invests primarily in corporate and government debt securities, primarily in Jamaican dollars. And again, that fund is more conservative. And for persons who want access to the global bond market, we have our FX Bond Fund. Our FX Bond Fund invests mostly in US dollars and mostly in US dollar securities as a result. Local and global corporate and government debt securities have varying tenures and kinds. We focus very heavily on diversification there. And if you want access to the international global bond market, we think that product gives you a very diverse means through which you can get in. And the minimum requirement to invest in that product is pretty low. It's a pretty low hurdle that allows wide accessibility.
Okay. So let's talk a little bit about that, right? In terms of recent returns
Yes.
for investors in the FX bond fund.
Yes.
What has it been like in, say, 2019? What was it like in 2018?
So in 2019, I think the FX bond fund returned about 7.2%, yeah, thereabout, which is not bad. I mean, 7.2% on Jamaican dollars in fixed income instruments is, we think, a creditable return.
And that would have been for the FX bond fund, that would have been a US dollar return, correct?
That is correct.
Yeah.
That's correct. That's on US dollars. The investments are made in US dollars and the returns are paid in US dollars. I mean, naturally, in the face of the pandemic, the FX bond fund, invests in the global market, and as a result, it was adversely impacted in terms of the return. And at the height, I believe year to date, the fund would have been down around 9.5%, and this is really at the bottom of the market. I mean, global markets really bottomed towards the end of March, the height of the selling, all of the panic, right? The stock market was down about 30% at the low in the United States. There were certain bonds that were down 20, 30%, as investors really expressed a very dim outlook. Even as I mentioned earlier, the government of Jamaica global bond curve was not spared. So the government of Jamaica has bonds that trade in the global market. And between the end of January, which is when this disease started to emerge in China, and it started to show up in the mainstream media, and the end of April, on average, the bonds on the government of Jamaica global bond curve fell by about 16%.
16.
Which is very sharp. I mean, on the longer end, like bonds maturing in 2045 and 2039, those bonds were down 30%, high 20% in terms of the value falling. So, that was significant. So even though, our fund was down 9% relative to individual instruments of similar risk, it wasn't down as much, and that's the effect of diversification, at work. The fact that we don't have all the eggs in the portfolio in one basket, it really helps you on the way up, but it protects you on the way down. But since that bottoming, that down 9%, we've actually rebounded from that low, almost 7%. We're now down year to date about 4%. And year over year, we're actually still up. I mean, so relative to last year this time, if you had invested last year this time, you'd be up about 2-3% on your investment, even after all that has happened in the face of this crisis. I mean, it's important to note for investors that bonds are more moderate to high risk, depending on where along the spectrum of risk you invest in the bond market. And they are medium to long-term investments, right? So you have to be willing and able to commit capital over the course of, 2, 3, 4, 5 years to really start to see the real returns that these type of investments can produce.
Okay. Yeah, so Ramon, that was an important point that you made about the FX bond funds performance. So if we look at the traditional conservative investor,
yes,
they would just buy a straight up bond, but they would have been worse off doing that performance-wise than if they had gone into the fund, right?
Yeah, well, I mean, in some sections of the market for sure, because of course, you can't make a blanket statement, but let me give you an example. So government of Jamaica, I mentioned, has global bonds. They have a global bond that matures in 2028. Right? And prior to the onset of this crisis, that bond was trading maybe 117, 118 in terms of price. Right? And in the height of that crisis, I mean, you could have bought that bond in some instances at 93, 95, which is a material decline in value, for sure. I mean, the bond pays 6.75%, $6.75 for every $100 you invest every year, right? Which is the income, and that's good. But that sharper fall in price really does erode a lot of the value of your investment. So, in anything that you do, in any portfolio you have, it is imperative that you diversify. And the FX bond fund, one of the benefits is that it affords you that diversification with a fairly low, minimum entry amount. I think the minimum amount to buy into the FX bond fund right now is between $100 and $150. So
US dollars?
yes, US dollars, yeah.
Okay, so coming into the crisis,
Yes.
or well, in the crisis, we heard the popular statement, cash is king.
For sure.
So coming into the crisis, the professionally managed global bond fund, its liquidity position was adequate.
Yeah, well, I mean, not to get into too much of the details
Yeah.
of our investment strategy, but broadly, heading into this crisis, Barita was fairly conservatively positioned respecting global bond exposures. And that's because I can't say we predicted the crisis, and I can't say we spotted the potential onset of a recession, but we generally thought that assets were a bit pricey, right? We thought that traditional fixed income, be it high yield bonds or emerging market bonds or even investment grade bonds, which is higher quality, because of that 10-year cycle of uptrending prices and downturn in yields, we really thought that those instruments broadly were exposing investors to a bit more risk than the return was compensating for. So as a result, we were conservatively positioned. We had to focus more on shorter term investment opportunities that were going to give us back our principal more quickly, so that in the event that in a year's time or 6 months' time, or in this case, immediately, there was a severe downturn in the market and things were a lot cheaper, we were well positioned to rebalance and start to pick, choose and refuse and be selective in terms of the opportunities that we diverted those funds towards. And it turned out to be a reasonable move. It turned out to be a good move.
Okay, so the typical advice that we give to investors that we invest for the long term, you maintain your discipline, right?
Yes.
Don't allow your emotions to take over regardless of what the environment is. Now, in the height of the crisis,
Yes.
had an investor resisted the panic, and for example, when you saw that -9 print, made material investments into the fund at that point, how would such an investor be performing today?
Well, I mean, it would have turned out to be a very good decision. It's very hard to invest in the height of panic. It takes nerves of steel.
Yes.
No one wants to try and catch a falling knife, right? And I mean, towards the end of March, that's exactly how the market looked. It looked like more like a falling sword, right? Falling off the 20th floor of a building. And it would have been very hard for any investor, sophisticated or just your regular Joe, to commit capital at that point. But if you had, you would have been rewarded, justly rewarded too. I think from that point to now, the fund is up about 8% in a very short space of time. That would be what 2 months or so, and you would have had a 8% return on US dollars. I mean, but it's important for investors to focus more on sustained returns over time than short-term tactical returns. Those will come.
Yes.
This market is very dynamic, and you will at points invest just at the right time and sell just at the right time. But that's a hard thing to repeat, right? So what is more consistent though is having optimal portfolio positioning, so being in the right types of assets, in the right quantums, and to your point, having an investment philosophy that is not easily derailed by market conditions. So it's not about being stubborn, but the word you used is being disciplined, right? Taking the time to assess, market conditions have changed, but has the situation with my portfolio changed, right? What's the outlook? Is what is going on now transitory, or will it have lasting effects? How will those lasting effects impact how I'm invested? And do I need to reposition? And you don't have to do it alone. It's important to know that we are here for you at Barita. We have a number of licensed financial advisors who can help you with that decisioning. That's what we do.
Okay, all right. So in terms of where we're going, so we've seen this recovery. And I mean, we were talking with Richardo yesterday about V, grinding it out. Right now, markets seem fairly confident,
Yes.
right? So if let's go with markets for a minute, right? They're very optimistic. We saw surprise improvement in the U.S. labor market. That report came out this morning.
For me, right?
Yeah, for the last month. So the question is, let's say we take these data points, increase cruise bookings, and we take data points like American Airlines coming out yesterday and saying they're going to increase their flight capacity, so like 74%.
Yes.
And all of those anecdotes that speak to a vigorous recovery.
Yes.
Let's say that, even though it's not our base case, let's say that happens.
Yes.
In a 0% world in terms of the Federal Reserve's policy rate.
Yes.
How do we start to look in terms of the global bonds and emerging markets that we are invested in? How does that asset class look going forward in those circumstances?
No, that's a very good question, and it would help me to answer if I had my crystal ball with me. But I'm going to try to give you a good answer with the data that is available currently. So the fact is, I can't say it enough that this situation is unprecedented.
Yes.
The last crisis that we faced was financial in nature, and it was the result of really cracks in the global financial system, really serious financial imbalances that existed. This crisis is brought on by a health crisis, right?
Yes.
And the modern world has not seen anything like this before. We have to look back to the early 2000s, I suppose, 1918, the onset of the Spanish flu, for something like this. And even then, the world was not as interconnected as it is now. So, we have now been in the midst of this for maybe 3 months. And what we have learned so far, the outlook shifts depending on one, the progress respecting treatment and, the development of a vaccine, and how persons view how quickly that can be integrated into the system, in terms of going into production and actually getting into the hands of persons. So my view up to this point is that you have to take a balanced approach. The resurgence in the market for me, in some instances is a little bit concerning, just because it seems to be disconnected from the fundamentals. The fact is that this pandemic has set us back maybe 2 or 3 years in terms of earnings of companies. Just speaking now very broadly and speaking globally. A lot of companies are going back to 2015 and 16 levels of business activity, and it will take some time for us to build back up. So the economy isn't going to be that V. We're going to definitely rebound, but I don't expect things to rebound immediately back to where they were before. And certain sections of the financial market seem to be implying that, right? So our own view is that, one, we are squarely focused on value, right? We are getting down into the fine details of the balance sheets of companies, looking at their liquidity, looking at the composition of their customer base, trying to suss out their continued relevance in this new world that we're going into post and with the COVID-19, the virus itself, right? Not just the pandemic, but the virus actually being in the world. And we're really just trying to connect the dots to ensure that any investments we make, whether it's in equity security, whether it's in a debt security, we're doing so on the basis of strong fundamentals, and we're doing so on the basis of our own view with respect to value. So, momentum has taken over at points in financial markets over the last 10 years where, this rising tide is just lifting everybody up, and, persons have been doing a lot of passive investing. They've just been buying the index. So instead of stock picking, they're just buying the S&P 500, right? And that works very well when things are going up, but it sometimes really hurts very badly when things are going down, right? So our own approach in the face of what's going on now is that, one, the outlook isn't very clear. There are several risks to the rebound that we've seen in the market. A lot of economies are opening back up. and a lot of economies that got very restrictive very early, and as a result stemmed the spread of COVID-19 are reopening, right? Which would mean that a number of countries are actually going to see post-reopening more cases than they would have seen to date, meaning, post the reopening period, exactly a second spike. And it's important to see what that will do to confidence, because at the end of the day, confidence is what really fuels business activity, consumer activity, and by extension, market activity. So if we see an upsurge in cases and we see a downturn in confidence, that could translate to market making another nosedive. So what we are doing, we are at this point in time, within the context of our overall strategic portfolio management, which looks out 3 years, 5 years, depending on the horizon of the portfolio. We're being very tactical. We're being very nimble. We are making decisions on a day-by-day basis, depending on the data available to us. Somebody once told me that, the trading part of investing sometimes leaves you looking very schizophrenic. Today you get up and you put on a trade, you make an investment, and then, in a couple of days things change and you have to revisit, right? And that is, I think, what the regular investor gets from relying on a professional. So when you invest via a vehicle like a unit trust, like our FX bond fund, you get the persons who can sit and get up at 2 o'clock in the morning and worry about what's going on in the market, looking at what's going on in Asia and Europe, focusing on managing your money, right? That's what we do every day. So that's really how we're approaching things. On a day-by-day basis, we're updating our outlook. We think the risks are still very balanced. It could go in either direction right now, quite frankly. And we're really just sussing out value, looking for value.
Okay, so if I'm hearing you right, your outlook, you sound like a Nike swoosh type of man, like in the middle recovery shape.
Yeah. So I'm usually not shy from taking a definitive position, but given everything that is happening, right? Given the uncertainty, my position changes at times week by week or month by month. Don't get me wrong. Longer term, we definitely think markets are going to end up higher, right? We have seen enough downturns and crises to know that. Sometime following them, markets do regain their footing, confidence does return, and things end up high again. But what we are trying to do is ensure that in the intervening period, while things remain in a lull and while asset values in different segments of the market keep showing volatility, that we are positioning the portfolios optimally to not only capture value once things start to go back up, but to preserve value if things are a little bit choppy, over the course of the next several months of uncertainty. So that's really our job, to preserve value and to create value. So that's what we're trying to do.
Okay, so it's a fast-moving situation.
It is. Keep looking. It is. It's a bullet train.
If I'm summing up the data that we've been having in terms of the high frequency data out of the US,
yes,
the case rate has been steady to declining, right?
Yes.
So that's good. Second spike and much sickness is bad. But regardless of what happens, you can trust that Barita's team is there, staying on top of things and making the necessary adjustments.
Yeah. We're trying to. The fact is, it's all about the relatively speaking, right? And really in the face of declining markets, some sections of the market are down 50%. You really saw the outsized move in entertainment type stocks in the United States, travel related stocks in the United States, and even the fallout in oil, what that did to energy related stocks and bonds. in the United States. But what we're really trying to do is preserve as much value as possible and position investors in our different portfolio management products to benefit once things start to move up again.
Okay, so they can rest assured that in this environment, if they're investing in the FX bond fund or indeed any of the unit trust funds, the Barita Brain Trust is fully engaged.
Fully engaged. We have you covered. We're trying to make the money work for you. At times the market puts your money on a little vacation, but we're trying to get the money back to work.
Re-employed, right?
Exactly.
So what was your closing message that you'd like to?
My closing message to the investing public is don't panic, right? That's the first thing. Irrational decisions are made in the face of panic, right? Don't panic. It's important for you, naturally, not everyone will become an investing expert. It's important for you, the longer you invest, you should be feeling more and more comfortable over time. So what that means is that have your scheduled conversations and visits with your financial advisors. And when you go there, have some smart questions to ask them. Keep updated with the news. Actually know what's in your portfolio, even at a very high level. So you might know, I know I have some money in local stocks and I have some money in international stocks and I have some money in international bonds. So you can, ask relevant questions to your advisor so you can get the information that will allow you to, in your own way, determine whether you're appropriately positioned, So that's the first thing, not panicking, keeping in touch with your advisor, trying to understand in your own way what's happening in the market. Next point is that this crisis has really emphasized the importance of diversification. It's critical that you don't have all your eggs in one basket. And the fact is that there are a number of asset classes that were doing very well heading into the crisis, which would have attracted a lot of investors. It's important to not concentrate your portfolio in the asset class that's doing very well today. So not because local equities are doing well, I'm going to sell all my portfolio and divert those funds to local equities, because the local equity market has been hit just as hard and in some places even harder than what has been happening in the United States, right? The other point I want to note is that you need to know your investing style and know where you're comfortable, right? So you need to define how much risk am I willing to take, right? And again, that will align well to your return profile. You need to recognize that higher returning investment opportunities tend to present higher risk of loss. So when they do well, they do really well. But when they do poorly, they tend to do really poorly. So you need to define upfront and come to a conclusion, what your level of risk taking is, where you're comfortable, right? So that's the third point. And the final point is, again, one thing that this crisis has emphasized is the importance of liquidity, right? Now, all of us have different portfolios, different size portfolios, different types of portfolios with different objectives. But one thing that should be uniform among all investors is that you have to have, as small as it may be, a pocket of liquidity set aside for two things. One, you don't want, in the face of an emergency, you hear that there's a pandemic and you have to go to the supermarket to buy some more things than you would usually buy. You have to turn to your stock portfolio for liquidity. That shouldn't be the case, right? You should have at least a little thing set aside. Some people call it an emergency fund, where you can access that liquidity to deal with that unforeseen event. And the second reason why you want to have some liquidity set aside is that you never know when the market will present you with the buying opportunity of a lifetime, right? And you don't want to be fully invested in the face of a sharp fall off in the market and have no liquidity to take advantage of these lower prices. So if I can reiterate, one, don't panic. Two, you need to, I can say in one line, you need to read to succeed. So you need to get more comfortable and in your own way, get an understanding of how you're investing. Thirdly, you need to diversify. Don't put all those eggs in one basket. Don't chase the best performing sector of the day, right? And finally, liquidity. Put aside some liquidity.
Sounds good. Ramon, thanks for joining us.
No problem, man. No problem.
blessings.